Hello, my name is Peter Hughes and I'm the chairman of the Risk Accounting Standards Board. I'm an English chartered accountant and I'm also a visiting fellow and advisory board member in the Centre for Banking Institutions and Development at the Durham University Business School, where for the past 5 years or so I've been leading research into risk-based accounting methods and systems. During my 25-year corporate career at the Chase Manhattan Bank, now JP Morgan Chase, I was at various times Chief Financial Officer of two of the bank's largest overseas subsidiaries in Brazil and Germany, Head of Finance Shared Services, and Chief Risk Officer of the bank's Global Shared Technology and Operations Division. In this video, I'll explain why the Risk Accounting Standards Board, or RASB, the Association of Chartered Certified Accountants, or ACCA, the Professional Risk Managers International Association, or PREMIER, and the Durham University Business School agreed to form a joint initiative on accounting reform. Perhaps the best way to explain why we believe accounting reform is necessary is through a case study. And we've chosen the 2018 SEC Regulation 10K annual report filed by United Airlines. We're specifically looking at 2018 because it's pre-pandemic and for other reasons that will become clear later. In 2018, United Airlines reported a net income of $2.1 billion. Now, I'm no expert on the aviation industry, but that strikes me as a very healthy profit. If we keep that performance in the back of our minds and thumb through the Regulation 10K annual report, we eventually land on a section titled Risk Factors. United Airlines posted 26 risk factors in its Regulation 10K filing. And I'll read just 4 of them so you get an idea of what's included. So the first, unfavorable economic and political conditions in the United States and globally may have a material adverse effect on our business operating results and financial condition. Second, high and/or volatile fuel prices or significant disruptions in the supply of aircraft fuel could have a material adverse impact on the company's strategic plans, operating results, financial condition, and liquidity. Third, the company relies heavily on technology and automated systems to operate its business, and any significant failure or disruption of either the technology or these systems could materially harm its business. And the fourth is a bit of a catch-all. The company's operating results fluctuate due to seasonality and other factors associated with the airline industry, many of which are beyond the company's control. And the other factors cited by United are extreme or severe weather, outbreaks of disease or pandemics, air traffic control congestion, geological events, political instability, terrorism, natural disasters, changes in the competitive environment due to industry consolidation, tax obligations, general economic conditions, and other factors. United concludes by making a statement that should give us accountants cause for concern. And I quote, "As a result, historical operating results in a quarterly or annual period are not necessarily indicative of future operating results." End quote. So what confidence can investors and United's other stakeholders have in a profit of $2.1 billion? Our answer, very little. What else can be the case when a board, CEO and CFO announce a $2.1 billion profit, but in the next breath they tell us they accepted 26 different risks when making those profits, all of which can potentially, and I quote, "have an adverse effect on the company's business operating results, financial condition and liquidity." End quote. In 2020, United Airlines reported a pandemic-fueled loss of $7.1 billion, which illustrates the degree to which historically accepted risks can materially impact future financial performance and condition. The fact is, current accounting standards do not address the acceptance of non-financial risks and the probable future impacts on financial performance and condition. We accountants would presumably argue in our defence that a non-financial risk is inherently unobservable. Only outcomes are observable. So, accounting standards are focused exclusively on reporting historic resolved outcomes and disregard what is likely to happen in the future. Organisations like the SEC recognise that investors and other users of financial statements aren't getting the whole story from accounting. And it's not unreasonable for investors to insist on knowing to what extent accepted risks are likely to affect reported financial performance and condition. But in the absence of an accounting expression, organisations like the SEC instruct companies to make relevant narrative or statistical disclosures of investor-critical financial information outside the financial statements. But as we have seen with United Airlines' 26 risk factors, when called upon to disclose investor-critical financial information outside the financial statements, companies default to a catch-all, all-inclusive mindset with little or no consideration of the probable impacts on financial performance and condition. This is a trend that is increasing as exposures to non-financial risk increase. And exposures to non-financial risk have grown exponentially in recent decades. They include climate change, manufacturing, transaction processing, supply chain, cyber, geopolitical, fraud, conduct, model, and legal and compliance risks, and I'm sure there are many others. The greater the exposures to these risks, the more meaningless and irrelevant accounting profit becomes. Indeed, the investor community and others have publicly stated their loss of confidence in accounting profit and have suggested it be replaced with a new measure. And that new measure is sustainability. So, what do we mean by sustainability? There are probably many definitions out there, but the one we prefer is: sustainability is an organization's capacity to provide investors with reliably predictable returns on their investment in financial, environmental, and social terms. In other words, sustainability is an organization's financial profit or loss, which is the backward-looking or historic perspective, adjusted for the expected losses associated with accepted non-financial risks, reduced by the mitigating effects of environmental, social, and governance or ESG attributes, which is the forward-looking or future perspective. ESG attributes include an organization's human capital, intellectual capital, business networks and relationships, environmental protection, and the well-being of communities that mitigate non-financial risks and enhance shareholder value. It is undoubtedly the case that the existence of non-financial risks and ESG attributes, in the absence of generally accepted quantification, valuation, and accounting standards, undermines investors' and other stakeholders' confidence in accounting profit. A new branch of accounting is called for, which is the focus of the joint initiative on accounting reform. And we're calling this new branch of accounting risk accounting. The joint initiative on accounting reform has been formed to build on a novel, non-financial risk quantification and accounting technique, first pioneered in the banking sector and further developed and tested as an extension of management accounting in a research collaboration between RASB and the Durham University Business School. The origins and evolution of the risk accounting method are described in my book, Where Next for Operational Risk, which includes a step-by-step description of the method with a complete set of illustrative tables and templates and examples of risk metric calculations and aggregations. To progress this initiative, we need the active engagement of accounting and risk subject matter experts to adapt it for other industries. We also need the engagement of CFOs and CROs from multiple industries, including the banking sector, to sponsor this initiative and facilitate access to live operating environments for field testing. If you want to be involved in this initiative, just click on the Call for Action button at the top of the RASB homepage. Thank you for watching and listening to this video.